Hey everybody, so I wanted to do a little video on something people are talking about, and I think there's some really great lessons in here, things that I've talked about for a long time. If you followed me on YouTube or you've done any of my programs, mentoring programs, etc., this isn't as easy as doing what the textbook says. And this is certainly an example of something I don't think is a great idea. As always, this is for educational and information purposes only. It's your trade and your responsibility. So if you're okay with that, keep watching. If not, we'll see you in the next video. Which is these guys run a service. It's guys who's they call Captain Condor, right? The guy from Spot Gamma called him Captain Condor, and it's stuck. And what he does is he sells these 0 DTE short-term iron condors, which is a strategy where you try to collect a bunch of premium, and if the market doesn't move very much, then you keep it. So down here, you can see that you're selling an out-of-the-money put spread, you're selling an out-of-the-money call spread, and you're receiving a premium for each of those, sometimes a little bit different, and they add up, and your risk is going to be the distance between the two strikes on one of those legs there. So you tend to do the same distance on both of them. So you're selling that bull put spread and you're selling the bear call spread, and you're receiving a credit. In this case, what they tend to look for is something around $2 on a 5-point spread. So what that means is you're receiving $2. It's somewhat aggressive, but you're receiving $2 to risk losing 3, receiving 2 to risk losing 3. Now, why would you do this? It doesn't sounds a little lopsided. Well, people sell premium. They like to sell premium. I like to sell premium, but only very sort of strategically when it makes sense, when the pricing is right, when the stars are aligning. If you do it systematically, I think selling premium is kind of a difficult thing. You need more edge than just saying, oh, well, options tend to be too expensive, right? Which tends to be the case over time. We call that the volatility risk premium, and that term is going to come back in. So I'm going to tell you about this. I'm going to go through the sequence of what happened here. There'll be some lessons, and I'll show you the things that I like to look at to prevent something like this, which is very, very important, I think, over the long run. So we'll talk about these things: iron condors. We just talked about volatility risk premium, the Martingale. Is it a great idea? Volatility matters to premium strikes. This is really, really, really key, right? So the level of option volatility out there, we call that implied volatility, is going to help to determine the strikes that you're going to sell if you want to target a certain amount of premium. So I want to show you this. Let's say we're talking about the VIX of Apple, right? So volatility, implied volatility, 15%. So think of the VIX at 15. Let's say this is the VIX of Apple. 15%, if you're looking at a 20 delta, which is sometimes a way that call and put sellers sort of target that delta because it's a moving target, right? And we're going to see why that is here. At a 15% VIX or a 15% IV, that strike that you're selling on the call side is 52.15 versus 50 on the stock where it is. So that's 4.3% out of the money. But what happens when the VIX or volatility goes up to 25? So this is your option pricing increasing to a 25% implied volatility for this term, which is 30 days generally we're talking about here. At a 20 delta, well, now the strike price of that option, the 20 delta, is 53.58. So that's quite a bit further away, $3.58 above where the stock is trading versus $2.15 above where the stock is trading. So the stock is the same price. It hasn't moved, but because the implied volatility is higher, that 20 delta is reflecting a higher strike. And that makes sense, right? When the market becomes more volatile, if you're sort of an option seller, you want there to be a little bit more room for you to be wrong, which is for the stock to get to that strike price and beyond. So that's why the delta is kind of a nice way to target levels in a strategy, because that's essentially moving along with the volatility, prevailing volatility. If volatility drops, then those strike prices get closer because the market's not doing very much. So it sort of works a little bit for those kinds of strategies that follow a delta, which is that moving target. Now look what happens when we go to a 35 implied volatility. That becomes $5 above where the stock is trading, and that's now 10% out of the money. So you can see as volatility goes up, the strikes rise, but, and important to our case today, as volatility drops, our strike prices get closer and closer to where the stock is trading. Now, the premium can go up or down, depending. We'll see that the iron condor, that the Captain Condor kind of looked for a similar price at first, and then had to accept a lower price because of the very important things that we're going to talk about in a moment. So there's no question that we want to pay attention to volatility when we're option traders, and when option prices get a little bit too cheap, we start to take on a lot of gamma risk. How does the martingale work? Well, let's say here's an easy example. You're going to bet $1 on heads. If the result is tails, you lose $1. Okay, well, we better up our bet. Got to make our money back, right? So we're going to bet $2 this time. Oops, the result is tails again. So now we've lost another $2. We lost $3 altogether. Now we're going to bet $4 on heads, right? We're doubling our bet each time, 1 to 2 to 4. The result is heads. We won. So we get our $4, which covers what we lost in the first two bets. So the idea is we want to keep increasing our bet to make back some of those losses and to hopefully end up on top. So now next one, we bet $4 on heads again. We're betting the same thing, right? We're not flipping over to tails. We're betting on the same thing in the hope that there's something called mean reversion, which is basically the idea that something has to come back to the sort of statistical probability. You know, flipping a coin is 50-50. So it can be tails so many times, but eventually it's got to be heads, right? Well, we don't know how long that's going to take though. So we bet $4 on heads. The result is tails. Uh-oh, we lost. So we lost our $4. Then the next bet, we double our bet again. So we bet $8 on heads. The result is heads. We get our $8. We win $8. Idea is that eventually you're going to more than make up for any losses in the strategy. And that again is kind of an idea that there's going to be mean reversion. Now, can you flip 25 heads in a row? You can, and that's a problem, right? So this is the kind of thing. Look, Chow, who runs the strategy, says he had calculated the chances of a total loss to be vanishingly small. Well, guess what? What else was vanishingly small? A 25 sigma event, 1987 stock market crash, was the possibility of something that should have only happened on the order of 1 in a trillion. Well, 1 in a trillion chance. How many crashes have we had since then? A bunch. Are these 1 in a trillion chances? Are these 1 in 5 billion chances? Are these 1 in a billion chances? No, there's a higher likelihood of that. Now, some of that has to do with the bell curve and you know, looking at a normal distribution, stuff like that we're not going to get into, and that's where there's some flaws in this. But basically, the sort of people, the analysts, the number crunchers out there, sometimes they make assumptions that are not correct, and this is clearly that it is not a 1 in a trillion chance that there's going to be a crash, because we have crashes now and then. So we have to be careful when we look at statistics. But we have to also concede that we can be wrong for a long, long time. What do we need to be wrong, and eventually make up for that? Well, we need to be bankrolled, right? So you can keep doing this in theory until it works out. But if you can't keep bankrolling that strategy, then eventually you're going to run out of money. You're going to blow up. And this is what happens. So let's talk about the way this trade played out. So first trade we have back here in our Iron Condor chart. So generally they put on these trades. It depends. There's some nuance to it. They skip days sometimes, depending on some of the things they watch. But first trade, basically you sell 1 Iron Condor, right? We know the next trade, if we lose, is going to be bigger. So if we win, then it's the same trade that we made the previous time. So they set out to sell the 67.20, 67.15, DC19 put spread, and the call spread, 68.15, 68.20 call spread. They received $2 for that. They did it 4,400 times, right? So they have a set size position that, you know, each person does different, you know, different kind of dollar amount based on their account. And so you're collecting $2 to risk $3, collecting $2 to potentially risk $3. What happened? Well, let's take a look at the chart. We see that after this sort of big high beta sell-off here, we came all the way back, almost got to those old highs again, and then we had a little oopsie daisy as we were expecting the Santa Claus rally to come, and everybody thought, uh-oh, is Santa Claus not going to come this time? And eventually he did, right? So we saw this move here. They did this trade, and they did not expect as big a move because, of course, remember, we want things to stay relatively still. And that first trade had a pretty decently wide margin on it, right? So pretty wide margin. You see, they did the trade here. So we can see they did this trade. And then this one expires on the 19th. So we can see that the market jumped right through that and they took a maximum loss on that, right? So basically, the maximum loss is going to be the market, the SPX in this case, moving beyond up to or beyond that upper strike, right? So the maximum loss is going to be somewhere between the short strike and the long strike on the call in this case because the market moved up. So it moved all the way through that spread and above the upper strike, and that resulted in the maximum loss. So what did that mean for them? So they took a loss of 1.32 million on that size. Well, the second trade, which they did after the close on Friday the 19th, right? The other one was done the day before. So this involves upping the size. So we're going to up the size. Remember, the first one was 4,400 contracts. Well, this one's 17,000 contracts. So a much, much bigger size, expiring on the Monday. So this is taking over the weekend. You're taking some risk over the weekend. So they sold 17,000 and they received $2 again. But volatility is dropping, right? Option pricing is dropping. So one of the things that I teach people is it starts to drop. You get those deltas moving in and you're starting to take a little bit of risk. Sometimes you're going to accept less money, as we'll see in a moment. That was the case. But in this case, they still grabbed the $2, which they grabbed in the first trade. But this time they sold the D's 22nd, 67.95, 6,800, and then the 68.60, 68.65 call spread. So notice that the first trade had a $95 range where they could grab the maximum benefit. How do you get wider ranges? Well, remember, we just talked about it. If option volatility expands, then you're going to be able to get the money that you want by taking less of a path dependence risk, right? Because our risk always in selling options is path dependence, right? Where is that stock going to go? You can be right on volatility, but right on the direction. And I'll show you some examples of that in a moment. So here's an example of how, look, in a low volatility environment, so this is literally from my course from a while ago, about a year and a half ago. And this is where I was making the exact point that is important to why these people got killed. Look, you can have volatility option. You can have the VIX going sideways, basically doing nothing, and yet the market is rising, right? The VIX is doing nothing, yet the market is rising. Well, that's because you tend to get a kind of a drift up in a positive market, right? So let's think of the reasons why this is going to be difficult, because the first trade had a $95 range and this one has between 6,800 and 6,860. So this one has a $60 range. So to get the $2 they wanted for a $5 spread, they had to accept a $35 more narrow range. Why is that happening? Well, we're going into the end of the year. Volatility is compressing, right? As it often does going into Christmas and the holidays. And to get the money that you want, you're having to accept a more narrow range. So you have, on the one hand, it makes sense because it's supposed to be a quieter time of year. So it sort of is supposed to make sense. But what happens is you often get this seasonal effect. So let's talk about what is the backdrop for pain in doing something like this at the wrong time? Well, the seasonal effect. After what we had a pretty good sell-off there earlier in December, and then we bounced back and we sort of pushed on the spring, as I like to say sometimes, and we started to rally. So seasonal effect, for what that's worth. Generally, people are buying up, especially this year where a lot of fund managers have really, really pooped the bed and have not performed. They're having to scramble into the end of the year and try to find some performance. There's a lot of rejigging going on. And what's another thing? Well, don't short a dull market. That's been a saying for as long as I've been trading, for 3 decades. Don't short a dull market. Why? Because it tends to rise. You're going to get hurt. And in a low VIX, the drift up is normal, right? So I've had people come to me this year early on, S&P at 5,800, 5,900, 6, and I said, don't be selling calls. This thing is going, AI is big. The VIX was not necessarily super, super low at all times, but often was very, very low. And that's when you get this market that's just kind of climbing the wall of worry. So I've had clients say, listen, you've saved me like 800 grand, not having, as I've avoided doing a lot of these cover calls. So you have that as well, which is what I described here. Look at the market going straight up, and really volatility is not doing anything. And then you also have these things. This is a kind of bonus round here because this is a little bit deeper, but you have these Vanna and charm effects, which is volatility and then a drop, the time narrowing, right? So as we get closer to expiry, those out of the money calls and puts are dropping in delta. And also, as implied volatility drops, so when the VIX comes down, well, suddenly those out of the money calls will go from a 30 delta to a 20 delta. Now market makers who are hedged, maybe sold futures against those, they've got to buy those back. And the puts maybe that they're hedged against are dropping in delta as well. And so the hedges, let's say they've in theory are short some aspect against those short puts. Well, now those puts aren't as big of a problem. They've dropped in delta, so they buy those futures back. So they're buying futures for both reasons, as implied volatility drops, and as time passes, that affects deltas as well. So as volatility gets compressed, we know we saw VIX in the 13s. Well, guess what? That means probably we're drifting up in general. So second trade goes wrong and they lose 5.1 million this time. So now what? Now we're in a little bit of a pickle, but guess what? What do we have to do? Well, we've got to keep going. We're martingaleing it, right? We do the next trade, which is now we're having to accept volatility keeps dropping. It's supposedly getting quieter, although we know there's movement. It's to the upside, but these guys don't care. They don't know the things that I'm telling you, right? They haven't done this for 3 decades, and they're going, okay, well, we got to keep going. So now they only get $1.75. They're not even getting $2 anymore, and they're accepting a 45-point spread. They've gone from a 95-point spread to a 60-point spread, now to a 45-point spread. So they're the level, the range of outcomes within which they are safe is getting more and more difficult to stay in, right? You're starting to have to kick that field goal through uprights that are kind of going narrower and narrower. Imagine the NFL if the uprights are like moving around like this. That would make things kind of fun for us as viewers. But man, it would get tough once those uprights start to get narrower. Guess what happens? It goes through the bloody thing again, because it's now the bar for getting through the upper part of the Iron Condor is lower and lower in a sense if the market's going to keep doing this. And look what it keeps doing. Up, gap. Now they're going, oh my gosh, this can't keep going, can it? This can't keep going. So the next trade, we're getting less time because it's Christmas, right? So we closed at 1 p.m. on Christmas Eve. And so now, because of that, there's less time. You're not going to get very much to begin with, right? So now you're going from getting $1.75 because it's a half day, basically. Now you're getting $1.45. They sell 99,000 contracts. Remember, they're martingaleing. They have to increase that size. They've got to Hail Mary this, speaking of football, to get that money back again, because my gosh, the tide has got to turn, right? Doesn't it have to turn? Doesn't the market have to turn in our favor at some point for one of these trades to work out? Isn't that the right thing to happen? Well, it may not happen. And this is what happens. They sell 99,000 contracts versus 4,400 the first time. They get $1.45. They're doing the 68.85, 68.90, and the 69.20, 69.25. Look at this tiny, tiny little gap. It's like trying to drive a bus through a little doorway now. Basically, the S&P jumps again on Christmas Eve. Like anyone couldn't have predicted that. That's happened how many times in the last decades? And the straddle going into the final day of the year was 15. I don't know. Maybe that's reasonable. Maybe we figure, they certainly, as part of what they're doing is rules because they have to do it. I don't know if there's a lot of we figure going on, right? But maybe you figured Christmas Eve, what's going to happen where the market's going to open, just sit there all day and then just not do anything. Well, guess what else you're battling? Guess what else you're battling in this kind of environment? Profiting after the market closes. Look at this. Now, this is a little bit older, back to 2018. Be interesting to see an updated version of this. But look at this. How much of the S&P's gains have come overnight? And what we mean by overnight is, well, the market gaps up and then it does its thing during the day. Well, this is what it does during regular hours between 93 and 2018. Between regular hours, it hasn't really done anything. But overnight, stocks tend to gap. So if you're selling premium the night before the previous day, and you're hoping things kind of stay quiet, well, you're kind of battling this effect, right? I mean, overall, we know stocks go up over time, but the fact is they tend to do a lot of that overnight, meaning, the gap up on the open, and then it continues beyond that. So this is yet one other thing that is wrong with this strategy, which I know sometimes works. So I'm not calling these guys out for being idiots, but it really not being aware of certain things. And I'm not a big fan of strategies and certainly Martingale type approaches that can blow you out of the water. I mean, some of these people are done. They're done. Their accounts, their life savings are gone. And so the thing here is you got very, very little, and you had to take on increasingly more and more risk, right? And so here's that skew that you're dealing with as well. So to the upside, your upside tends to be, look at, like, the S&P has terrible, terrible upside skew, almost at the best of times, unless you see some technical reason to really get in the way. And sometimes call skew explodes and the vol's really, really high, which we've seen the last few months. And I've said, yeah, it's actually probably not a bad time to sell some calls. And it's been better, right? But under normal circumstances, upside calls in the S&P are just really not great. You have all these funds hammering those calls, and that really puts a lot of pressure on those things. So notice what happened here. The first trade, the group was risking $3 to collect $2 with a 95-point range. By the last trade, they were risking $3.55 to collect $1.45, but with this very important feature, with a 30-point range. Now, was the volatility risk premium high? What's the volatility risk premium? Let me show you what that is. So the volatility risk premium is the comparison. Let's take comparison here. We have a couple different terms, right? This is 1 month S&P option pricing versus realized 10-day. And I'm giving you this for a reason. This is literally a slide. I've not changed anything about it. This is a slide from last year that I used to teach in my program. And here's your at the money that is moseying along here. And you can see that I think it was the same period that we looked at back here. And you can see that, oh, that's the wrong one. You can see that as realized volatility really drops, as it does sometimes. I'm sorry, I have the dates on here. I'm not sure why I had those cut off, but this is like 2024, around, probably one of these is Christmas. Anyway, this is probably the same period that I was looking at here. So you can almost think of this as, yes, I think this is probably it here. So, Jan to July 2024, something like that. And you can see that eventually the option pricing refuses to drop. So watch what happens here. Option pricing moves with underlying volatility, right? So it moves with realized volatility, which is the actual market movement. And they should, right? Risk should reflect underlying on pricing. Pricing should reflect underlying risk. That's kind of how insurance works, right? Car insurance, life insurance. That's how they price insurance, based on the underlying risk. Well, in the market, it's the underlying risk of movement. But eventually, notice what happens here is you have the at the money S&P option pricing get to a certain point, and it doesn't like to go down any more than that. Look at this, here, 3, 4 spots, 4 touches. It does not like to drop below a certain level. We have 10 here, 10 implied vol. What realized volatility does is it's not about refusing to do anything, because it's actually looking in the past, and what happened. You can't fudge this. This is a rolling 10-day realized volatility, and it gets down to around 6. And what I found over time, remember, this is from a year and a half ago. What I found over time is that, actually even further, no, about a year and a half ago, is that when realized volatility gets down to sort of that six-ish, it doesn't get too much lower than that, six-ish, between 6 and 8, is where the option pricing refuses to drop anymore. It just kind of says, it's too cheap. And I think that's the market saying, eh, we're due for some sort of movement, right? Even though realized volatility has to reflect reality, which is maybe the market has gone absolutely quiet, right? Here, a realized volatility of under 6 in the S&P 500, that feels like it's almost not even open, right? For traders, that feels like zero is happening. But when that happens, you have this big gap that opens up. Here's your implied volatility on a little slightly longer term basis. And here's your movement in the market. What do you call this? That's a volatility risk premium, right? The market's only moving here, but options are priced here. Well, a textbook would tell you, man, that's a huge volatility risk premium. You should be selling this premium all day long. The problem is when it gets that wide, something's about to happen. Look what happens. Gets down here, boom. Gets down here, boom. Gets down here, boom. Gets down here, boom, right? There comes a point where this gap, even though technically from a theoretical standpoint, there's a bunch of money to be made in a sense, that's not the case. That's why I use certain measures in Turbo Trader Pro and some of my programs. I use certain measures where it's like, sit on your hands time. It looks like it's a good idea to sell a whole bunch of premium, but it's not. It's not. And this is where you get into trouble. And this is what these guys completely ignored, whether it's the rules or they just don't know. It's probably more the rules. But these are not sophisticated traders. This guy running this thing, I guarantee you, he is not a sophisticated trader. He has very little clue about any of the stuff that we're talking about today. He's caught lightning in a bottle, and all these people have joined his program, and it probably works over and over. But that's how these things work. I've noticed over the decades, you get people, they do these short vol programs. We saw it blow up in 2018. You do it, and you make a whole bunch of money, even if it's like a fund. You make a whole bunch of money. You make money off fees. You make money off performance. And then the thing blows up, and you go, oh, okay. And then you close it, and you open up another one. This is a very, it's not that unusual to see. And it is often good for the people who sell these programs because those periods can persist, right? These periods can go on for like 3, 4, 5 years. You feel like, you can never lose a dime, and then something happens. But look at that. And so this is a measure that I use in my programs. And here's what we have lately. Well, here we go again. Look, this is recently. We got almost the same thing again, down to about a 6 realized volatility. Here it is again. Look at that. Even this is I showed you a completely different period. This was last year. And guess what? It happens again. Down to a 6, down to a 6, down to a 6. When this happens, it's trouble. And what did we get? We got trouble. Boom. We got trouble. And then these guys start hammering out volatility in these trades. And this is eventually what happens as a result, right? We got a big sell-off and then a slingshot back up because of AI, because of Christmas, because of whatever, because of people offside. And you pushed on the spring and boom, this is what they sold into. And that is a very, very dangerous thing to do. So I thought that was kind of a cool sort of thing to look at. I call this, picking up pennies in front of a steamroller. It's not that I don't like option selling strategies, what I do, but I do it intelligently. I do it strategically, and I stay away from those times when it is best to sit on your hands, right? So it's hard to do, right? So I think a lot of traders kind of struggle with that. I have no problem sitting on my hands and doing nothing for 3 or 4 days because the opportunity doesn't present anything, even for a couple of weeks. It's hard you go on vacation, you go stay at the Bellagio, you've brought your big nice wad of cash, and you're like, I'm ready to play. And then for some reason the odds aren't in your favor. And what? I'm supposed to sit around by the pool and maybe the weather's not great, and I'm supposed to sit around for 2 days and not play. Well, I'm only here for 4 or 5 days or 3 days. I want to play. I came here to play. I think a lot of people approach the market with that as well, thinking that they've got to do things all the time. No, you've got to do smarter things less of the time, right? If you just do volume, you're just trading for excitement. Go to Vegas for that. But if you really want to make money, you've got to stay away from doing things that are going to really, really hurt you. Now, Martingale just makes things even worse. But this theory holds in general. This whole picking up pennies in front of a steamroller, that holds in so many different trades out there that I've seen people blow up on over the years. So, you know, I encourage you to check out my Turbo Trader Pro program. It's the world's very first professional income scanner developed by an actual pro who's done this. I've managed $1 billion in option strategies. I've managed income ETFs, downside swan ETFs. I was a market maker, pro market maker for 15 years, only making money if I got a check. If I made money at the end of the month, I got a check. The long strategies, short strategies, everything in between. This is the stuff that goes into this scanner. The brains, you're going to get inside my head and hear all the things and understand all the things. You're going to get inside my head and get all the benefit of the good, the bad, the ugly, and the experience, right? There's trading and investing. A lot of people, I'm not saying this is brain surgery, but there's art, there's science. You can learn a lot of that science from a few good people around, but the art of it really comes from having done this for a very long time and having those instincts. And so I encourage you, check out the program. It's fantastic. We did have a sort of sales price a little while ago. I don't know if you reach out to info@theturbotrader.com, info@theturbotrader.com. And ask Natasha nicely. She may give you a better price on it. We'd love to have you. We don't want too many people in it, so I will be adhering to that. The price basically tripled, so I will be adhering to that new price soon. So this is your chance for the new year. Start off strong. It comes with weekly sessions. This is not give you a trade once a month and we'll see you and good luck, you never hear from me again. I am doing classes every week. I am teaching. You're watching, you're following along with my portfolio. We're doing trades together. We're learning why things work, why things sometimes don't work, what to do about it. This is really an absolute mentoring education for a lot less than my mentoring program, which is like 20 grand. And I don't even take people on anymore. I turn people away. I literally turn people away for $850 an hour now because I'm doing so many other cool things that excite me that I really want to focus on stuff that makes me happy and I feel is giving more value to more people, right? Win-win, one to many. I do well, everyone does well and gets an Ivy League education. By the way, I'm Ivy League as well, so no BS there. So, this is all about giving you as much value as I can. I'm not going to hold your hand. I'm not going to tell you this is guaranteed money or guaranteed that you're going to hit it out of the park every single time. That's just not the way markets work. If you want that, go grab the slingshot strategy from that chef who's, trying to sell you some crap. There's a lot of stuff out there like that in the age of options guru grift. So enough about all this stuff. I'm going to give you too much of an earful. Everyone have a wonderful New Year's, and we will see you in the new year. Hopefully we'll see you in the program. Take care.